So CAPM model is basically the capital asset pricing model. It's basically a financial model that describes the relationship between systematic risk of investment. So what is systematic risk is whatever would be the financial loss associated with that particular investment and expected return for assets. So what this asset means is assets is something which represents value of ownership that can be converted into cash. So it can be tangible or intangible, that is you can touch it or you can feel it, otherwise it can be intangible, untouchable, or you cannot feel it, right? So it is a linear relationship between required rate of return on an investment and risk. So it is used widely for pricing the risky securities and generating expected returns for assets, given that the risk and the cost of capital has been mentioned. So basically, what can be the risky securities? Stocks, bonds, mutual funds, exchange traded funds, as in case of Bombay Stock Exchange and National Stock Exchange, whatever would be the exchange traded funds. Then it calculates the expected rate of return for an investment. So the formula is ERI is equals to RF plus beta of the potential investment in bracket expected rate from expected return from the market minus risk-free rate. Here ERI is the expected return of an investment, that is equals to risk-free rate plus beta of the potential investment multiplied by the market risk premium. So what is market risk premium is ERM minus RF. So investors expect to be compensated for the risk and the time value of money. So we know what is risk. Risk is the financial loss associated with a certain sort of investment. And what is the time value of money? Is the money today is worth more than the money tomorrow. That is because money today can be used or invested or it can be grown. For example, $1 which is earned today is not the same as that $1 earned 1 year from now, because the money earned today can generate interest, unrealized gains or unrealized losses. The risk-free rate, that is RF and CAPM model, it accounts for the time value of money. The goal is in order to evaluate whether a stock is fairly valued, that is a fair value has been obtained from a particular investment, that is here is the risky stock, when its risk and time value of money are compared with its expected return. And beta of a potential investment is a measure of how much risk the investment will add to a portfolio that looks like the market. Here, if beta is greater than 1, then the stock is considered as riskier than the market and it's better to buy stock from the market rather than this option. And the second point is if beta is less than 1, then it reduces the risk of your portfolio and this is a better option. You can go with this sort of stock. For example, an investor is contemplating, that is, he's thinking of a stock which is valued at $100 per share today that pays a 3% annual dividend. Say that this stock has a beta compared with market of 1.3. Therefore, it's more volatile than a broad market portfolio. That is S&P 500 index. Also assume that the risk-free rate is 3% and this investor expects that the market to rise in value by 8% per year. Given stock price is $100 per share, RF is the risk-free rate which has been given, which is 3%, and the expected return from the market is 8%, and the beta of the potential investment is 1.3, which has been given. Here, putting values in the formula will get the answer, that is expected return from that particular investment is 9.5%, and thus we can conclude that the expected return of the capital asset pricing model formula is used to discount the expected dividends and capital appreciation of stock over the expected holding period. And if the discounted value of those future cash flows is equal to $100, therefore CAPM model formula indicates that the stock is fairly valued relative to the risk.